What if you could get paid just for owning shares of some of the world's biggest, most stable companies? That's the magic of dividend investing, and today, I'll break down 5 powerhouse dividend aristocrat stocks that can put real passive income in your pocket. We're talking about building a reliable stream of cash that can fund your lifestyle, retirement, or even your next coffee run. In this video, you'll discover a leader in healthcare real estate, a giant in energy infrastructure, a consumer goods legend, a global agricultural linchpin, and a rock-solid real estate trust. These aren't random picks. They're companies with strong fundamentals, impressive dividend histories, and the potential for serious returns. I'll show you what makes each one tick, why they're set up for success this year, and how you can use them to build your own passive income machine. So grab your coffee, hit that like button, subscribe to the channel, and let's dive in. If you only watch one video today, make it this one. You won't want to miss a single detail. Let's start with Universal Health Realty Income Trust, ticker UHT, a quiet dividend machine in the recession-proof healthcare sector. The company leads the aristocrats with a commanding 7.66% dividend yield and 40 consecutive years of increases. The healthcare REIT, with a market cap of $535.82 𝗟𝗡, owns medical facilities and has maintained dividend growth at 1.35% CAGR over the past year. UHT is a REIT that owns hospitals, medical offices, and healthcare facilities, essential services that are always in demand. Their tenants are healthcare providers on long-term leases, giving UHT a steady, reliable stream of rental income. As a REIT, UHT must pay out at least 90% of its taxable income as dividends, making it a favorite for income investors. Right now, UHT offers a high dividend yield, often in the high single digits. That means for every $100 you invest, you could get close to $10 a year in dividends before any stock price gains. But it's not just about yield. UHT's business model is built for stability. Their portfolio spans 76 properties in 21 states, anchored by a strategic relationship with Universal Health Services, one of the nation's largest hospital operators. With an aging U.S. population, demand for healthcare and for UHT's properties is only set to grow. UHT's long history of paying and growing dividends shows management's commitment to rewarding shareholders. While risks like policy changes or rising interest rates exist, UHT's focus on essential healthcare helps insulate it from broader real estate downturns. You're investing in the backbone of American healthcare, real, tangible assets that generate income. UHT is often overlooked, but that's where opportunity lies. While others chase flashy stocks, UHT quietly delivers steady returns. It's a perfect anchor for a dividend portfolio, offering high income and defensive stability. Of course, no investment is risk-free, but UHT's track record and sector focus make it a compelling choice. For October 2025, if you want a serious income producer with a proven model, UHT deserves a spot on your watch list. You're not picking which hospital will win. You're the landlord to them all. That's the power of a well-chosen REIT. UHT's consistency, high yield, and essential role in healthcare make it a top pick for income investors. If you want to build wealth with reliable dividends, UHT is a name to know. It's simple, effective, and built to last. For anyone seeking passive income, UHT is a must-consider. Add it to your portfolio and let your money work for you. That's the beauty of dividend investing. Let's move on to our next powerhouse. Next up is Enterprise Products Partners, ticker EPD, the circulatory system of America's energy economy. The company offers investors a 6.94% yield, backed by 28 consecutive years of distribution increases in the midstream energy sector. With a substantial market cap of $67.91 billion, EPD has delivered robust 3-year dividend CAGR of 4.67%, while maintaining a reasonable payout ratio of 79.55%. EPD is a master limited partnership, or MLP, that owns over 50,000 miles of pipelines, storage, and processing facilities. They don't drill for oil or gas, they get paid to transport and process it, acting like a toll road for energy. This fee-based model means EPD's cash flow is stable, even when oil prices swing wildly. For investors, that means reliable, high-yield distributions, often in the high single digits. EPD has increased its payout for 25 straight years, through every crisis and market cycle. Their assets are irreplaceable. Building a competing pipeline network would be nearly impossible. EPD connects key supply basins to major demand centers, making them essential to the U.S. and global energy supply chain. They're not just sitting still. EPD is expanding into high-growth areas like natural gas liquids and petrochemicals. The result? A forward-looking infrastructure business, not just an old-school oil play. One thing to note, MLPs like EPD come with unique tax forms, K1s, but the high, often tax-deferred income is worth the paperwork for many investors. EPD's strong balance sheet and disciplined management set it apart from riskier energy companies. When you fill your car or use plastic, chances are EPD's network played a role. You're investing in the backbone of modern life. The combination of high, stable distributions, a 25-year streak of increases, and a wide economic moat makes EPD a powerhouse for income-focused portfolios. While others guess oil prices, EPD investors collect steady cash. For October 2025 and beyond, EPD is a foundational piece for building serious passive income. It's a leader in its field, built for resilience and growth. If you want reliable, high-yield income backed by hard assets, EPD is a top choice. Add it to your watch list and let your portfolio benefit from America's energy infrastructure. That's the power of smart dividend investing. EPD delivers cash flow, stability, and long-term growth potential. For income investors, it's a must-consider. Let's keep building your passive income machine. Next up, a controversial but cash-rich giant. Stay tuned. On to our third pick. Our third pick is Altria Group, ticker MO, a controversial but undeniable dividend powerhouse. The company continues its remarkable 55 consecutive years of dividend increases, currently yielding 6.45% with a market cap of $110.48 billion. Altria owns Philip Morris USA, maker of Marlboro, and dominates the U.S. tobacco market. Yes, smoking rates are declining, but Altria's pricing power and profitability are unmatched. Even as volumes fall, they raise prices, keeping cash flow strong. The result? A massive dividend yield, often 8–10%, and a legendary track record of over 50 consecutive annual dividend increases. Altria is a dividend king, showing a deep commitment to rewarding shareholders. But they're not just clinging to cigarettes. They're investing in smoke-free products like oral nicotine pouches and e-vapor. The big question, can Altria's new products offset the decline in cigarettes? For now, you're paid handsomely to wait and see. The high yield compensates for industry risks, regulation, litigation, and shifting consumer habits. Altria has weathered decades of legal and regulatory storms, proving its resilience. Financially, it's a fortress. Billions in free cash flow, a dominant brand, and a powerful competitive moat. The investment case. You're buying a company the market has written off, collecting huge dividends while management executes its turnaround. It's a value and income play. Not for everyone, but compelling for those focused on maximizing yield. If you have ethical concerns, skip it. Your portfolio should reflect your values. But for pure income seekers, Altria's high yield and history of shareholder returns are hard to ignore. Even if the stock price stagnates, the dividend alone can beat the market. And if their smoke-free strategy succeeds, there's upside potential too. For October 2025, Altria is the high-yield, high-risk, high-reward play in our lineup. It's a bet on management's ability to adapt and keep rewarding shareholders. If you can stomach the controversy, the potential rewards are substantial. Altria is a classic income stock, controversial but cash-rich. Consider it if you want maximum yield and can handle the risks. That's the Altria story. Let's move to a global supply chain giant with a twist. On to our fourth pick. Our fourth pick is Universal Corporation, ticker UVV, a global supply chain giant and dividend king you've probably never heard of. The company delivers a 5.87% yield with an impressive 54 consecutive years of dividend growth, representing one of the longest streaks among aristocrats. The tobacco leaf processor, valued at $139 billion, maintains a conservative payout ratio of 77.99% and trades at 13.60x earnings. Universal is the world's leading supplier of leaf tobacco, acting as a middleman between farmers and major tobacco companies. They don't make cigarettes. They supply the raw material, with a global network that's nearly impossible to replicate. Like Altria, UVV faces declining tobacco volumes, but they've managed this with discipline and efficiency. The result? Over 53 consecutive years of dividend increases and a generous yield, often 6 to 8%. The market worries about tobacco's future, but that's where the opportunity lies for income investors. You're paid a high yield to own a resilient, cash-rich business. But UVV isn't standing still. They're pivoting into plant-based ingredients. Recent acquisitions have expanded them into fruits, vegetables, and botanicals for food, beverage, and pharma markets. They're leveraging their global sourcing expertise to tap into high-growth industries. This strategic shift could transform UVV from a tobacco supplier to a diversified agribusiness. As their ingredients business grows, the market may re-rate the stock, offering upside beyond the dividend. You get the safety of a dividend king and the growth potential of a food tech play. For October 2025, you're investing at a turning point, collecting high dividends while UVV builds its next growth engine. The balance sheet is strong, and management is disciplined with acquisitions. UVV is building a business for the next century, not just the next quarter. In summary, high yield, a resilient legacy business, and a smart pivot to growth. It's a have your cake and eat it too scenario for patient income investors. If you want stability plus upside, UVV is a unique pick. Add it to your watch list and watch the transformation unfold. That's the universal story. Now, let's finish with a real estate legend in reliability. On to our fifth and final pick. Stay with me. Here's the anchor for your income portfolio. Our final pick is National Retail Properties REIT, ticker NNN, the definition of consistency and reliability in real estate. The company offers a 5.59% yield, supported by 36 consecutive years of dividend increases and a market cap of $8.10b. The retail REIT specializes in single-tenant net lease properties, maintaining a sustainable payout ratio of 66.53% while trading at a PE of 20.43. NNN owns over 3,000 high-quality single-tenant retail properties across the U.S. Think 7-Eleven, Taco Bell, auto shops, and gyms. These are service-oriented businesses that resist e-commerce disruption. NNN's disciplined acquisition strategy and focus on high-quality tenants have paid off for shareholders. With 34 consecutive years of dividend increases, NNN is another dividend king. Nearly 100% occupancy and a well-laddered lease schedule reduce risk and ensure steady income. NNN's strong balance sheet and investment-grade credit rating give it the firepower to keep growing. Their relationship-based approach means they help tenants expand, creating a built-in pipeline for growth. It's a win-win. Tenants get capital to grow, NNN gets more properties with reliable tenants. The simplicity is a major selling point. No complex tech, no volatile commodities, just solid real estate and steady rent checks. Of course, like any REIT, NNN is sensitive to interest rates and economic downturns, but its diversification and tenant quality help mitigate these risks. NNN is a rock-solid foundation for any income portfolio. Buy, reinvest the dividends, and hold for the long term. You own a piece of high-quality, income-producing American real estate. For October 2025, NNN is a must-consider for stability and reliable, growing income. It's the kind of stock you can count on, year after year. If you want peace of mind and steady cash flow, NNN REIT is your anchor. That wraps up our top 5 picks. Let's talk about your next move. Ready to take action? Here's how to level up your investing. Stay tuned for the final steps. Don't miss out. Let's wrap up. There you have it. 5 dividend stocks ready to deliver in October 2025 and beyond. From healthcare and retail real estate to energy and global supply chains, each offers a unique path to passive income. Remember, building wealth with dividends is a marathon. Consistency is key. Want to master value investing? Check out my Value Stocks Investing Master course, link in the description. For exclusive stock tips and in-depth analysis, join the Stocks Galore Patreon community, details below. Now, which of these 5 stocks are you most likely to add to your portfolio, and why? Let me know in the comments. Don't forget to like, subscribe, and share your thoughts. Thanks for watching. See you in the next one.